What if the wealthiest among us could simply vanish to avoid paying their share? But the real story behind their threatened exodus is not what you think. Whenever the topic of taxing high income surfaces, one predictable rebuttal always follows. We're told that a historic number of millionaires are planning to move abroad, that thousands are poised to exit major cities. The narrative is clear. If we increase taxes on the rich, they will depart, pulling their capital, their companies, and the jobs they provide with them. The ironic conclusion: we could end up with less total revenue, defeating the entire purpose. This concept, known as capital flight, is a hot-button issue from the UK to New York. Pundits warn we risk driving away the very individuals who built our economic powerhouses. News cycles are dominated by high-profile figures relocating to low-tax havens like Florida or Dubai. But what if the core assumption behind this fear is completely wrong? There's a famous economic model that describes the link between tax percentages and government income. At very low rates, revenue is naturally low. As rates climb, so does the money collected, but only to a certain peak. Push beyond that point, and you risk discouraging commerce so much that total receipts fall. Partly because people may indeed relocate. This relationship forms what's known as the Laffer curve. While the theory itself has a basis, its application is often stripped of all nuance, leading to questionable policy decisions. The first major error is misidentifying where our current economy sits on this graph. Advocates for tax cuts insist we're on the downward slope, claiming that lower rates would spur growth and paradoxically increase total revenue. However, most empirical evidence doesn't support this. A comprehensive study of numerous developed nations found that nearly all were positioned on the left side of the peak, meaning higher top-tier rates would indeed raise more funds. The United States showed one of the largest gaps between its current rate and its potential maximum. The reasons for this are more complex than just the tax code itself. Another flawed premise is treating maximum revenue extraction as the sole objective of tax policy. The ideal rate for society and the rate that collects the most money are not always identical. Taxes can be structured to provide relief to working families or to discourage harmful consumption. But the most significant oversight is the belief that the ultra-wealthy select their primary residence by scanning a global tax spreadsheet, ready to flee at the first sign of a higher bill. The truth is far more layered. Home isn't just where the lowest tax bill is. Recent analysis of global wealth reveals that European nations with steeper tax burdens have, on average, experienced robust wealth expansion over the past decade and a half. Even accounting for affluent immigrants, the countries with the highest typical wealth per person generally maintain progressive tax systems. Looking domestically, threats to abandoned places like New York have been made for years. Yet, its population of high earners has swelled to record levels. The city isn't an inescapable tax trap. One could live in a neighboring state and commute. The super-rich can even establish residency in a tax-free state while maintaining a part-time presence. These extreme cases generate massive publicity. One side points to them as evidence of loopholes that need closing, while the other argues it proves taxation is futile. But for the vast majority of wealthy individuals, is the math of moving really that simple? For most high earners, the professional networks, cultural amenities, and family ties of their home base outweigh the financial incentive of a minor tax saving. This brings us to the intriguing exceptions: California and the United Kingdom. So, let's dissect if a wealth drain is a genuine crisis or a political phantom. This portion of our program is brought to you by Brilliant. Brilliant is the dynamic learning platform that sharpens your analytical thinking and problem-solving skills. They transform subjects like data science and computer programming into engaging, hands-on challenges. Instead of passively watching, you actively build knowledge through interactive exercises. I've been exploring their Python programming course, which breaks down coding into manageable, creative steps. It's a refreshing way to develop a valuable skill. To start your own learning journey, head to the link in the description below. Brilliant is offering our audience a special discount on a premium subscription. Now, back to the question of wealthy migration. The UK reportedly saw a net outflow of thousands of high-net-worth individuals recently. While the precise figures can be debated, the trend suggests a shift. London was once a magnet for global capital, offering a welcoming financial hub and luxury services tailored for the ultra-rich. Over time, the downsides became apparent. I covered this in depth a while back, but the summary is this. They inflated property values, enabled large-scale financial opacity, and their net contribution to the broader economy was less than the special treatment they received. Sure, some local service jobs were created, but as being a personal staffer for an oligarch, the pinnacle of economic development. As regulations tightened to combat illicit finance and ensure a fairer contribution, some of this mobile wealth began to depart. The preferred destinations are now the new generation of low-regulation hubs. So exoduses can occur, but London is the outlier that highlights the norm. When you attract people solely for a good deal, they will leave for a better one. Competing in a regulatory race to the bottom is a fool's errand. Even if you succeed, you attract a transient class with little desire to invest in the community. Interestingly, even during this period, the total number of millionaires within the UK actually grew. This locally generated prosperity is far more stable because it's rooted in a sense of place. Most people, even the very affluent, will not abandon their homes, social circles, and familiar way of life solely for a marginal tax advantage. And that's presuming they have the practical ability to do so. We can see a smaller scale version of this playing out between California and Texas. Interstate movement is logistically simpler, leading to a noticeable shift of tech workers and businesses seeking lower costs and taxes. However, as office mandates return and the tech sector's center of gravity holds strong, some of the receiving cities are experiencing volatile housing markets that boomed on transient demand. A significant portion of an area's wealth is intrinsically linked to its unique ecosystem and established institutions. That earlier study on tax revenue found the US could potentially have a very high top tax rate because its domestic industries create such immense value. A wealthy American could theoretically renounce their citizenship for a lower tax bill abroad, but virtually no one does. Why? Access to American markets is often worth more than a tax saving. The opportunity cost of leaving is simply too high. The research wasn't advocating for such a high rate, but was demonstrating that the fear of revenue loss is largely unfounded. It's true that extreme wealth makes global mobility easier, and these moves are highly visible. But for broad economic health, widespread prosperity from many successful individuals is better than relying on a handful of billionaires. This pattern is evident in the very cities where flight fears are most loud. One chart perfectly contextualizes this entire debate. It shows the migration rate of millionaires across countries with the largest reported outflows. This isn't a mistake. The data suggests the number of millionaires moving represents a rounding error close to 0% of the global total. With tens of millions of millionaires worldwide, a few thousand changing their postal code is statistically insignificant. This also includes those moving for reasons like safety, politics, or retirement, not just taxes. But let's entertain the idea. Suppose a policy change did trigger a real flight of capital. Would it be catastrophic? In cases like certain unstable nations, significant capital flight has occurred. But it's crucial to distinguish cause and effect. It was the underlying instability that caused the wealth to leave, not the other way around. Research, including work by Nobel laureates, indicates the most damaging loss is not monetary capital, but human capital. Losing skilled professionals, doctors, engineers, managers inflicts a far deeper wound than losing a passive investor. Cash can be regenerated. Physical infrastructure remains, but expertise is both portable and incredibly difficult to rebuild. These professionals are typically less mobile because their credentials aren't always transferable. Therefore, The best strategy to retain valuable talent is to foster stable, well-functioning institutions where people want to live. Please like this video if you found it insightful, and make sure to subscribe to Winds of Thought for more content that challenges the conventional wisdom.